Hello everyone! New week, new lesson, let's roll! What do we have for today? Today we are going to cover the last, for now, revenue concept, unearned revenue. But let's recap what we know about revenue so far. We can get revenue from goods or services. We can also give discounts or get returns. But remember how not easy it was with the recognition of revenue. I mean, when you can say you have earned it. Yes, when you receive cash often doesn't matter for revenue. Well, of course it matters for you. You need cash in the end of the day. But in general, it does not. Revenue doesn't mean cash. Got cash? Stop and think. Have I actually already earned it? Were the goods delivered or the services provided? Have the transfer of the ownership taken place or services accepted? The key event that may get you in trouble with unearned revenue is prepayments, which you receive from your customer. It could be a prepayment for goods, or an annual subscription for services, or services to be provided over time. Though you have received money, you still have not transferred the goods or services. What is happening in this case? When you receive a prepayment, you basically take money from your customer. This is like a loan. The money you have received is not your revenue yet. It's your liability, your commitment to provide a service or to sell goods. But instead of a bank, you use your customer to finance you. Why would a customer finance you? Well, your quality could be the best in class. Or he may want to make sure he beats the competition and gets your product first. Or you are super reliable. Or he just loves working with you. Whatever the reason. The fact you receive cash in advance but have not earned it yet. What happens with your accounts then? This is very similar to loans. When you receive cash, it goes into assets. Let's imagine you have got $60. To balance the balance sheet, yes, this unstoppable double entry. You record a brand new line item, prepayments received in your liabilities. Yes, it is a liability. You owe your customer now. And you don't have anything in the income statement yet. You have not sold anything, and you have not incurred any costs. Let's consider two scenarios here. One for sale of apples, and another one for sale of a quarterly subscription for your online best in the world cooking recipes. So, scenario 1. We use the cash we have received from a customer to buy apples. We buy 3 apples for $10 each, $30 in total. They go into inventory and replace $30 in cash which we have spent. A swap. Liabilities stay as they were, we still owe our customer. Balance sheet is intact. No P&L, we are not selling anything yet. Now we sell the apples to our customer for $60, exactly as agreed and how much the customer paid us. What is happening with our financials? The moment we have transferred the apples, we recognize revenue, $60. Revenue has a cost. What is our cost? Exactly, our apples from inventory, $30. What we get? A profit of $30. Again, we have not spent a single dollar of our own cash to get it. Now second entries, as always. We remove inventory, we sold the apples, $30. This is the second entry to the costs. This decreases our total assets to the value of cash, $30. And revenue? The second entry to revenue now will be removing our liability to the customer, $60. We fulfilled his request and now we owe him nothing. Remember how earlier we recorded revenue on the balance sheet as a positive amount in assets, in cash or receivables? Here we book a positive amount into liabilities. This way we cancel out the liability, but the logic is the same, double entry. And sales mean a good thing happening, either increase in assets or decrease in liabilities. So, we are done with the revenue and costs. What is left? Profit, $30. What do we do with that? Right, it goes directly into equity. So, we put 30 into equity and now have a balance sheet with 30 in cash and 30 in equity. It balances and we have earned $30. Let's look at scenario 2, subscription to our recipes. For the subscription services, the prepayments you receive are called deferred income or deferred revenue. In IFRS world, and IFRS stands for International Financial Reporting Standards, You will see they are called contract liabilities, but it's the same. You get money in advance for the future services and defer it over a longer period of time. As you provide services over a quarter or a year with the fixed volumes and monthly amounts, they are very predictable. And every month you repeat the same procedure. In our case, for a quarter, you monthly record 1/3 as revenue and reduce your liability, deferred income, by 1/3. For annual prepaid subscriptions, you would record 1/12. And you repeat it every month in the same amounts, further decreasing deferred income and increasing accumulated revenue. By the end of the subscription, you will have zero liability and full amount of revenue, which will balance with the cash you have received, and the profits are going into equity every month. And of course, you can calculate it daily, and some companies do it. Let's look at an example and start with the same amounts of prepayments as with Apple's. And let's assume we don't have any costs to provide our recipes, so 100% profit. What a dream business! Instead of prepayments received, we will call our liability to a customer deferred income. Now, with every month, we will recognize 1/3 or $20 as revenue at zero cost and $20 in profits. On the balance sheet, we will gradually reduce deferred income by $20 in line with monthly revenue and increase equity by 20 in line with the profits. Cash doesn't change. And month 2, next 20, reducing deferred income to 20, increasing revenue and profits to 40. And month 3, next 20, reducing deferred income now to 0 and increasing revenue and profits to 60. In 3 months, we will accumulate $60 in revenue and profits, and we will fulfill all obligations to the customer and enjoy our profits and well-deserved cash of $60. If we were to have costs, we would have used cash to pay for them. As a result, we would have had less cash and less profits left for the balance sheet for the same amount. And the balance sheet will balance. Okay, we have learned about another important accounting topic today. Well done! Let's summarize it. Prepayments do not mean revenue at first. Unearned revenue is a liability for us. We owe our customers. Revenue is recognized when goods or services are delivered, not when cash is received. Double entry accounting keeps everything in balance. Deferred revenue is gradually reduced as services are provided. Understanding unearned revenue helps keep our financials accurate and compliant. In our next lesson, we'll explore the costs, another important topic for income statement. Thank you for watching the video. We hope this lesson helped you clarify how unearned revenue affects the income statement and the balance sheet. Don't forget to like and subscribe for more lessons on accounting and finance. See you next week.